This is Dami Solari and you're watching DS Learning Finance. We're back with another one this week, guys. Now you know a broker is the middleman separating you the investor from another investor, or you the investor from the company who's issuing the shares for the first time. Broker is the middle person. So with that said, you can give brokers 5 different types of orders. Want to find out what they are, want to know what they do, what the pros and the cons are. You know what to do. Keep watching.
I choke you down just like a pill. Take you like a pill.
First type of order, the first type of instruction you can give to your broker to buy/sell your stocks is an execution at best order. This is where you tell the broker, look, I want the best price for the share. They then go in the market and find the best price for you based on obviously what's going on in the market at that current time. So it's important to know this fluctuates, guys. It can be really good bargains in terms of the market then and there. It can be really awful prices that you pay or you buy/sell your shares for. So it's important to know it fluctuates with the market and where that market is at that pinpoint time that you're looking to get the best offer for. Now that brings me to my second type of order that you can give a broker. If there's a lot of fluctuations, a lot of uncertainty in terms of what is the best price, if there's a broad spread, then you can issue a limit order. This is where you set your maximum buying price and your minimum selling price. So basically trying to minimize your extremes. You don't want to buy at too high of a price because obviously that's bad, and you don't want to sell at too low of a price because obviously that's bad. Now the good thing about this type of order is that it can be on the market for an extended long period of time, 90 days to be exact. Or if it's past its expiry date, then it obviously ends up getting cancelled. Or you can just decide one day that you want to set up a different type of order and just cancel it then and there. But nonetheless, if you were to set this order, this limit order with your broker and forget about it, no interruptions, it will be on that system, it will be on the stock exchange for 90 days. So if you want to sell ABC stocks at £10 on the limit order, it will be there for 3 months time down the line, roughly. This is really good because it means that you won't feel forced to buy and sell your shares because you know there's an extended long period for your investment to occur. There's less pressure on you to invest then and there, or there's less pressure on you to sell then and there. So it's really good in terms of it really allows you to focus, set your targets, and obviously give a reasonable time window to achieve the type of order you can have arranged with your broker. Is called the execute and eliminate order. I call this the best of both worlds. The reason being is because it allows you to complete your transactions partially or fully, depending on whether the investor on the other side is selling or buying your shares that fit your condition, basically. So you set the price limit with your broker, and whoever fits that criteria makes the order. If some of the orders have been completed and then some of them are still outstanding, then the ones that are outstanding will expire. Now you can envision this will be awesome when you've got a huge amount of shares that you want to potentially sell for. So say for example, I've got 100 shares that I want to sell, ABC shares. I want to sell them for £11. So I tell my broker, look, this is my price limit, £11. So anything lower than £11, I will not sell my shares. Anything higher is ideal, but anything at £11, yes, I will sell it. So another investor comes and wants to buy my share for £11, but he just wants to buy 50. So instead of me having to restrict all of the investors that want to buy my share for £11, because I'm restricting them in the sense of they have to buy 100 shares as opposed to just 50. So that's the benefit with the execute and eliminate order. this is where you can tell, this is where the investor who wants to buy your shares or sell shares to you can partially make orders with you, depending on whether they meet your criteria. So in that case, the investor who was interested in my stock at £11, he can purchase 50. That's excellent. I've still got my profit, yes, but nonetheless I've still got 50 other shares that I still want to sell. So that's the bonus. It's a sort of gradual process. It's not like a sort of one lump sum where you sell all the shares in once. No, that's ideal, yes, but it's not realistic at times. So it allows you to partially sell your shares, and eventually, by the time you know it, everything's got. The fourth type of order you can execute is called the fill or kill order. Sounds serious, I know. The way I like to think about this is, you know, when you're going to, I don't know, get a new car, for example, you're going to buy a car for, God willing, 10 grand because you have the money. So you're going to buy a car for 10 grand. But you go to a car dealer and you're like, look, I like this car. I want to buy it for 10 grand. But you are willing to pay a bit more. Maybe you could pay 11 grand because you like the car that much. It's that sort of leeway. Then set your limit order according to those guys, that even though, yes, I may not be getting it for the best price, for the price that I initially wanted, you're still willing to pay above. That's the way I visualize the fill or kill order. So it's where you set your maximum minimum price and vice versa, where you set your minimum maximum price. What are your extremes? What's the furthest you're willing to go to, basically? Now with this method, you need to sell or buy all the stocks in one go. You cannot partially do it, so there's no benefit like the execute and eliminate order discussed previously. It's not like that. You need to purchase all the shares and sell all the shares in one go. So you need to have an investor who's fitting that criteria for you. If the deal is not executed in your set price criteria or better, then the whole order expires completely. Now the fifth one I've left for last, because this is a juicy one, guys. This is the one that everyone hears about. This is quite a popular one. It's called a stop loss order. Now people feel it is such a great idea to have a stop loss order. This is basically where you're like telling your broker, this, I want to sell my stock, yes, but this is the minimum price I want to sell my stock for. The reason why that is, I visualize that as a bad way of thinking about investment, is because you've already put that dark cloud over your head that it's going to fail. You've already assumed that you've got the worst, you've got to sell at a loss. And it's, even though it's quite a small assumption, and it may not seem that extreme, but it's like a snowball effect. It keeps carrying on, and then it gathers momentum. This is where you basically tell your broker, okay, I'm looking to sell these shares. I'm looking to sell at this minimum price because anything lower I just simply won't accept. So I bought ABC stocks for, I don't know, £50 down the line. I'm making it £50 2 years ago. I'm looking to sell them now because ABC stocks isn't doing it as well. So I will sell them for the minimum, very minimum of £7. Yes, I appreciate I've taken a loss, but I'm still selling them for £7 and I'm not taking a full fat loss, am I? A lot of people see that as a really good thing, but it's not, because like I said, you're visualizing yourself for a loss. There's also another big reason, but I'll talk about this in more detail in my conclusion. To sum it all up, guys, all of these orders are useful, but the key part is timing. You've got to utilize them at the right times. For example, you may not want to execute an order at the best price because it may be subject to fluctuations from emerging news, for example. So say there's a drastic disaster that's occurred and it's going to heavily affect ABC stocks. You've invested in them, then you want to quickly sell before anything dramatic occurs with ABC stocks. That's a sort of fake impact, as I like to call it, because yes, even though it will affect ABC in the short term, over the long term, ABC will just bounce back again. So a lot of people sell their stocks at that particular time because they're worried about the future, what's going to happen. But if they really see over the horizon, they'll notice that things are going to be right back where they were again. A limit order would definitely be good for someone for an investor who really analyzes the prices of the shares and the volumes. This is because they can set their maximums and their minimums in terms of selling and buying shares. That's great because they know what prices are true values of what's going on in terms of that particular stock. So say ABC stocks has a general trend that it doesn't exceed, it doesn't have a share price lower than, I don't know, £5. But because I've invested in it in £10 and I've really studied the price structure of it, what's been going on, what's the general trend over the past 10 years, over the past 20 years, however long it may be, because you really analyse that to a T, you can therefore pick up the general trend. What is the lowest trend? What's the lowest minimum price that it tends to go to? And what's the highest maximum price that it tends to go to? Now, to backpedal a bit with a big factor that makes a stop loss a really bad type of order to have arranged with your broker, is the fact that you should have done your research, guys. When you invest in any company, always do your research, guys. Always, always, always. More importantly, you need to do your business research. What is the business strategy? This is why I keep going on about it, guys, and I'll keep going on about it until I'm 50 years old. It's all about the business strategy. Yes, the financials do seem very, very appealing, yes, but beneath the cracks, beneath the surface, what's going on in the company? If you've done your real research, you'll know that ABC stocks has a good strategy, they have good morals, they have good ethics. What they're doing is providing an honourable service and product for the needs of customers, and it will continue doing that. Because you would have done your research properly, then you would have faith in that, as opposed to being wary because, okay, I don't know, one particular month ABC stocks may not be doing well because of one particular news line, for example, or I don't know, an accident happened in an ABC stock company, in an ABC stock store, and then that's completely affected their share price. But yeah, you know that has affected it for now, but the research that you've done has told you what ABC stocks is going to do in the future. So your business strategy, the business strategy of the stock that you're looking to invest in is very important, guys, because that will ultimately dictate whether a stock is worthwhile investing in or not. When you've done the fundamentals correct, when you've done the research, guys, about the business, then you will have no worries. Yes, you may have bought all of your ABC stocks for £10, but it's gone down to £1 and you're scared. You are willing to do a stop loss at 50p, but because you've done your research, you're confident that down the line, 2 months, 3 months, a year from now, ABC stocks are going to bounce right back up again. That's why it's important to do your research, because it then allows you to, with confidence, say, okay, I still have faith in that particular stock, even though it's not particularly doing as well right now. The key is right now, not forever. Now, to sum that point up, Warren Buffett says a really impactful phrase. Remember to be fearful when others are greedy, and remember to be greedy when others are fearful. That is so true. So that particular time, say ABC stock was plummeting £1, because I've done my research, I know ABC stock is going to bounce straight back up again. I know that it's a downright fact. The question is just when. Why not just buy tons more shares when it's £1? So then when it bounces straight back up to £10 again, you've literally tenfolded. You've got 10 times your profit, your initial investment. So yeah, guys, think about it and make sure you do the business research. And that's the end of this week's video, guys. I hope you enjoyed it. You know it's coming another week. You know it's coming next week. You really do. Whether you guys like it or not, it's coming, definitely. But yeah, all seriousness though, I hope you guys enjoyed it. Please like my channel, please subscribe, and please share. Please, please, please. I'm going to give you guys a second so you can do it. There we go. LSS DS Learning Finance. Bye.
Sound just like a pill.